Hi, my name is Sydney Wilson. I'm an Associate Wealth Advisor with Pointe. On behalf of our team, welcome to our webinar, What is Your Business Worth? Before we get started, we have a question for you. Do you know what your business is worth? If you do not know the value of your business, you are not alone. In fact, according to a survey conducted by M&T Bank and reported by CNBC, 98% of business owners in the United States are unaware of the value of their business. Today, you will discover 4 critical areas to focus on as you prepare to take control of your exit strategy. Whether you're planning to sell soon or just starting to think ahead, this session will give you the tools to plan with clarity and confidence. And as a bonus, you'll receive a gift after the session that will help you prepare for that eventual transition. Before we dive in, we want to hear from you. Using the Q&A button, please let us know how many years you've been a business owner. Only we can see your responses in the Q&A. While you're typing in the Q&A, I will introduce our speakers. We will start with Bjorn Nesvold. Hi, Bjorn.
Hey, Sydney. Hello, everybody.
So Bjorn began his career in the financial services industry in 2007. He has extensive experience helping individuals, families, and business owners develop a financial strategy based on their unique values and goals. When he's not in the office, he enjoys spending time with his wife and 2 children, coaching their various sports teams, and playing golf during the summer months. He also prioritizes volunteering in his community and currently serves as board president for Operation Help and as an ambassador for the Chamber of Commerce. Bjorn enjoys working most with entrepreneurs as he has run his own business and has been involved in the creation and driving of wealth in a business for as long as he can remember. He loves addressing the unique challenges each business faces. Next, we have Jack McNamara. Hi, Jack.
Hi, Sydney. Hello, everybody.
Jack is a part of the Twin Cities Beacon Point Advisors team along with Bjorn. He assists business owners, corporate executives, and retirees with comprehensive financial planning strategies and is a certified financial planner. In his free time, Jack enjoys running, biking, and skiing. Jack is driven by working with business owners as they are the type of clients where we can often add value right away and get to see their long-term commitment and perseverance. And with that, I will turn it over to Jack.
Thanks, Sydney. Looking at the Q&A responses here, it looks like we got a mix of answers as how long you've been a business owner, ranging everywhere from under 5 years to well over 30 years. So thanks for sharing. Gives us really some more insight into who we're talking to today. First off, thanks for joining us. Today's agenda is really going to cover 4 big areas. So the first, how to calculate the value of your business. What is your entity worth? Second, strategies to assess your readiness for an eventual exit. The third one's going to focus on determining the tax implications. Nobody wants to pay more in tax than they need to. So how do we look at tax? And then integrating the sale of your business into your long-term retirement strategy. So Bjorn, you're going to kick us off with that first one. How do we calculate the value of a business?
Yeah, sure. Thanks, Jack. So let's start with the idea of understanding wealth. As Sydney mentioned, the reality is that most businesses truly don't know what they are worth, with only 2% having knowledge of their current valuation. It's a bit of a shocking statistic, but it's all the more reason for some proactive planning. So how would you find out the value of your business? Let's start by taking a look at the roadblocks that you might run into along the way that may prevent you from really knowing what your business is worth. The first one is it can be expensive to determine, right? So we're looking at paying some sort of valuation group, what can be a hefty price tag to come up with a formal valuation that you could use to bring towards the sale process. And so just the pure expense of it can be the first one. The second roadblock is that it can be time consuming. You know, for a lot of business owners, they are focused almost solely on simply running the day-to-day, week-to-week, month-to-month operations of their company. And they don't view the time that it might take to go through that process as important, as a priority number 1 at the moment. The third one is that it can be complicated. It can sometimes feel like more of a burden than it is value. So you add up the fact that it's expensive, it takes time, and it can be complex and complicated. that, makes it more difficult for some people to focus on. And then the last one is timing. We know as a business owner that there's always something that needs to be done today, tomorrow, this week. And this can be often something that you can punt to the future, and it just convince yourself that it's never the perfect time to work towards that. So in the Q&A, let us know which of these reasons, or maybe any other reason, that would resonate most with you if you're someone who hasn't taken the time to take a look at the valuation of your business. And let's move on to the next slide.
Yeah, so we're going to play somewhat of a little bit of a game, but we're going to ask you really to cover the 4 key agenda items. We're going to go through the transition of your business and what we think you should be thinking about. So here's what we're going to ask. Grab a piece of paper and a pen, or you can pull out your cell phone and pull up your notes app. As we go through these, we're going to ask you to record your answer to each of the 5 questions. And at the end of the webinar, we're going to total up your score and discuss results. So make sure you got a piece of pen and paper, or pull out your phone, swipe up to your notes app, write down your score to each of the following questions. We're going to go through each of the 4 different agenda items here. So let's start with question number 1. All of these are going to be on a certain scale here of 0 to 5. So on a scale of 0 to 5, 5 being you have had extensive conversations, 0 is you have never talked with anyone about it. How much time have you spent discussing who would buy your business? So 5 is you've talked about it all the time and you know exactly who it is. 0 is you've had very, very or no discussions about it at all. I'll give you a second to write down your answers there. What we often hear is somewhere in the middle. You either know and you know exactly who it is and you've had extensive conversations and you're in the process of kind of putting that into action, or you have really not dove into it at all, because to Bjorn's previous point, you've been solely focused on the business itself and running the business to worry about what happens next. So when we look at, okay, who does buy your business, there's really 4 different types of buyers. And we're going to start with the first one, which is an internal buyout. So if the internal buyout could be a family member, it could be an employee. I want to start with the example of a family member, right? If you're running a family multi-generational business, you might know your kids are already working in the business, and you know that the acquisition of equity is going to get passed down to them at some time. That's an internal family buyer. It could be a key employee, right? So this could be your right-hand man or woman. This could be somebody who is you're grooming for talent that you know has the skills and has expressed interest in purchasing your business. So that'd be an internal buyer. The second would be a strategic partner. So a strategic partner could be somebody who complements or adds to your existing services, right? So think of in the case of a let's take the example of a wealth management company who is going to add on an accounting practice for their clients to be able to file their taxes. That could be a strategic partnership. Take a competitor, right? So this could be somebody that you own the wallet share in, and they'd like to increase their wallet share in the sector itself, right? So take 2 manufacturing businesses that compete against each other. One's looking to acquire the other to bundle it all together. The fourth could be really focused on an outside private equity acquisition. And this could be either an operator or a private equity team that's looking to purchase your business and focus on growing your business for a likely potential exit in the future as well. So pros and cons to each, but it's important to know who does buy your business. Bjorn, do you want to take us to question number 2?
Absolutely. So the next question is, how confident are you about the selling value of your business? Same scale, 0 to 5, right? So 0 is, I have no idea, no confidence whatsoever in what it's worth. And a 5 is extreme confidence. This would probably be someone who has already gone through a formal business valuation. So I'll give you a few moments to write down your answer here. And similar to question number 1, we often see a wide range of responses here, but typically the 0 to 3 range is the most common for all the reasons we've already stated. And so next, we're going to talk about the details you need to determine the value. And there's 4 different main types of valuations that you're going to find. The first one is equity value. And what is that? So equity value is when the buyer is acquiring all of the assets and the liabilities on and off the balance sheet. So this fair market valuation conclusion, it's the value of the company available to its owners or shareholders and incorporates all of the assets included in the asset value, plus the firm's liquid financial assets. Think of cash, accounts receivable, deposits, et cetera, and then minus its liabilities, so short-term, long-term, et cetera. The second type of value would be asset sale value. So this is where the seller keeps the cash and the receivables, but delivers the business free and clear of all debt. So this excludes financial assets and liabilities. This common transaction-oriented fair market value conclusion includes the firm's inventory, furniture, fixtures, equipment, and all tangible assets ranging from customer base to goodwill. Third, we have the enterprise value. Now, this is going to be a reflection of the firm's value as a functioning entity, and it is helpful in that it facilitates the comparison of companies with varying levels of debt. So the fair market value estimate is equal to the total value of the firm or the value of the firm's equity plus its long-term debt. It's going to reflect the entire capital structure or the enterprise, what it's called. And then last but not least is the liquidation value. Pretty much every time we're going to try and avoid a liquidation value because this is going to be based on the assumption of insolvency and the immediate sale of all assets on the balance sheet, coupled with the satisfaction of all debts. This will not include accounts receivable. We often refer to this as a fire sale, which is something we hope to avoid. So the liquidation value is based on the key assumption of insolvency and the immediate sale of all assets at or near what we call the fire sale level, coupled with nearly simultaneous retirement of all liabilities. So this will not include accounts receivable either. Jack, why don't you take us to the next slide?
Yeah, thanks, Bjorn. So we've kind of identified, Bjorn laid out step one, what is your business worth? Step two, who's going to buy your business? And that's on, you need to have these discussions of, is it an internal buyer, a family member, employee, or is it a strategic partnership? Is it a private equity group? And each of them have, again, their pros and cons. So we know what our business is worth. We have an idea of the different types of acquirers we'd like to find interest in. Now we're going to look at a little bit of the sales stipulation. And so upon the actual business operating agreement being sold itself, one of the things that can often be added is what we call an earnout. And so what an earnout is essentially a stipulation in that agreement that could be focused on revenue. It could be focused on a retention of clients. So it could be keeping a percentage of your concentrated clients. It could be focused on a profitability metric. And the time frames of those metrics can all vary just based off of the actual sales stipulation itself. There isn't an earnout tied to every single sale. However, we have seen the types of purchase agreements with earnouts can often result in more lucrative offers. So I think of it this way, the more skin you have in the game post-sale, the more lucrative the offer because it lowers the amount of risk for a buyer. Let's break down just a very simple example here. So let's take a manufacturing company who's received an offer from a strategic buyer, right? So I laid that out earlier. They have an EBITDA, earnings before interest, taxes, depreciation, and amortization of $2 million. And they're offering a multiple of 4. So that's going to get us to a total sale value of $8 million. The buyer will provide $4.8 million upfront in cash. So you're going to get $4.8 in cash on close, $2 million in a loan that the buyer is going to pay off over the course of, let's say, 7 to 10 years. And then the remaining $1.2 million is paid out if they hit $2 million of EBITDA in each of the next 2 years, and increases to $2 million if they increase EBITDA to $2.5 million. So that $1.2 million of kind of revenue and earnings growth would be considered the earnout of the deal structure. So our message to you is, do your homework, understand how is your plan impacted by either having or not having an earnout, and then hitting or missing those metrics as well is important. So we discussed the first agenda item of how to calculate the value of your business, including the types of buyers, the ways to calculate, and now we're going to turn our attention to the next agenda item, which focuses on how do we assess your readiness for an eventual exit? Do you want to take question 3 here for us?
You bet. So the third question here is, if you were to sell your business and walk away today, with what confidence do you feel like you know you can retire? Again, 0 to 5, same scale. 0 is I have absolutely no confidence whatsoever. 5 is I'm extremely confident. So I'll give you a moment here to jot down your answer. I'll let you know that this one especially is a wide range for people. Not all business owners have everything in their life financially tied to their business, but many of them do. And so if you have a low understanding of what your business is worth or a high understanding, that's going to weigh heavily on your response to this question. And so we see many different answers here where some people are of the understanding that their business needs to fund their entire retirement, and others may have other assets to add to the mix as well. So when it comes to that response and that question, that's when we address what's called the wealth gap. So the wealth gap is, the definition is it's defined by what your business is worth and the difference between that number and how much you will need in retirement. Simple example. I have worked with my financial advisor. I have recognized that I need $2 million to retire, and I have now realized that my business is currently worth $1 million, and that is really solely funding my retirement. So my wealth gap in this example is $1 million. So the larger the wealth gap, the larger the dependency on the sale of the business, and the greater the need for advanced and delicate planning. You should also, learn and know your numbers. Our team, when we work with business owners, we use a variety of different planning tools. One of them specifically uses what's called Monte Carlo testing, which helps to remove, what I would say the luck from your transition. So it shows based on varying, let's just say varying amounts of proceeds from the sale of your business, how that looks for the future of your retirement, impacted by varying levels of inflation, market volatility, ups and downs, et cetera. And so plugging those numbers into those planning tools with our team is going to go a long way to helping you figure out what your wealth gap currently is. Jack, you want to take us to the next one?
Yeah, so let's play out that example of a $2 million need in retirement. Let's say we diminish that wealth gap. We get your business kind of to that 2 million. We understand what it's worth. How do we make sure that 2 million lasts for the remainder of your lifetime? Because that's most important, right? Our job is to both grow and protect your assets. So I want to illustrate the importance of a withdrawal strategy and really just how important that is. So we're going to take 2 retirees here. Both have sold their businesses for a little just under $1 million is what they're entering into retirement with. Both are going to be invested in a moderate portfolio, so 60% stock, about 40% bonds, and both are going to take out 4% each year. Okay, so exact same scenario. Mike's going to be on the left in our orange, Ann's going to be on the right in the green. So looking at the left, I want to focus, your eyes are going to jump to kind of the red figures, and we're going to focus on the columns a little bit. So we're going to start with $1 million. Mike's going to retire in a period which the portfolio returns are negative. So you can see those first couple of years are negative for Mike. And he's got high inflation. So Mike ends up with periods of high inflation, not too far off from where we had been in the last couple of years a little bit. If we look to what happens for Mike, he's going to withdraw 4% each year. Mike, after 22 years, runs out of money. Not good. Now let's flip it to Ann. Ann's in the exact same scenario. She's got just under $1 million. She's going to take out 4% each year. However, Ann's going to retire in a period in which portfolio returns are high. So market returns are really good. We're in a rip and bull market, and inflation is very low. So after 24 years, where Mike ran out of money, Ann ends up with nearly $7 million. A $7 million delta. That's not nothing. So what's the big key takeaway? We don't want your retirement success to rely on luck. So to ensure that we're not leaving your chances of running out of money up to chance, we utilize a bucketing strategy. And we do this by investing assets that are needed in the next 3 to 5 years in more conservative assets, such as bonds. And we often see a much more conservative portfolio for the 3 to 5 years worth of income needs. And then for our longer term assets, such as our more growth assets, we're going to use higher weightings to stocks and alternatives, such as private equity, private credit, things of that nature. So this bucketing strategy mitigates the risks of market fluctuation and luck impacting your plan. Can we mitigate the luck on your ability to fund your retirement comfortably? Really, really important. This is the sequence of return risk if you've never heard of that one before. If you want to take us to question 4 here.
Yes, absolutely. So the question 4 is, how confident are you about what variables influence how much your business is worth in the eyes of a buyer? So again, same scale, 0 to 5 here. 0 is I have no confidence, and 5 is I'm extremely confident. And I'll give you a moment to jot down your answer on that scale as well. This one here, we tend to see a little bit on the lower range, but we do, get answers across the board. It's just, it's not something that every business owner is thinking about when they're keyed in on just running their company. Let's move on to the next slide here. So what is it that drives value? There's 4 main things, right? So as a business owner, you know where your revenue comes from, which customers pay the bills, and the number of clients you serve. However, one misunderstood topic is what variables do buyers consider as they place a value on your business? So if you believe your business is worth X, why does a buyer come in and view it as Y? And what variables do they place the most weight on? So the first one is intellectual property, right? So this is what we'd call the secret sauce of your business, what you know about your competitive advantage in your specific industry or sector, and really what you bring to the table personally or your team. The next is going to be the types of revenue and how that revenue is generated. So the biggest difference in the revenue type is going to be recurring versus one time. So a really simple example I will often use is a landscaping company, right? Now, if you forget about just kind of the lawn care or irrigation component of landscaping and focus on what they do when they come in and do the builds for brand new homes or a complete refresh on a existing household, oftentimes this is a one-time revenue generator for them because the client isn't going to hire them to do that every single year. Might be every 7 to 10 years. Now, a recurring revenue situation is going to be clients you have that maybe are on a subscription model or that need your services every single month of the year ongoing. The difference in how recurring versus one-time or periodic revenue is calculated for value by a buyer is massive. Recurring revenue tends to be valued significantly more than one-time revenue. Next, we have the predictability or the dependency of your revenue. How predictable is it? Who does it come from? And more importantly, what percentage of your revenue is driven by your top customers? It is really great to have, let's just say 3 in this example, reliable, consistent customers making up 75 to 80% of your annual revenue because you feel like you can count on that. Now, conversely, a buyer coming in might view that as a potential liability, that if when the business changes hands, if they lose 1 or 2 of those 3 main clients, that could have a massive impact on the annual revenue. And then last but not least, your management team, right? So can your business run without you being there? Can you go on vacation for a week or 2 weeks? What if you are ill for a month and can't be there on a day-to-day or week-to-week basis? Do you have a management team in place that can run the operation without you physically there or you running the show even from home? Buyers are going to put a premium on a business that has a solid management team in place. Jack, why don't you take us to the next agenda item?
Yeah, really, really important slide there. So we want to focus next a little bit on tax. So scale is 0 to 5. 5 is I have a very thorough understanding of the investment strategies to reduce tax liability. 0 is I have no knowledge of investment strategies to reduce tax liability. So how well do you understand the different types of investment strategies to reduce your tax liability in the year of the sale? Go ahead and write your number down there. And I'm going to jump right away into, what are the different types of ways in which we can reduce some of that tax liability and minimize that tax liability. So the first one is what we call a direct indexing and kind of a potential long short investing. And these are strategies that can be used to help offset capital gains. So for many of you, you have a very low basis in a business, you sell your business. So your basis in a business is $1 million. You sell your business for 12 million. You've got $11 million or so roughly in there of capital gains. How do we mitigate that? And there's a strategy we use and implement with investors to get them invested in equity markets, but generate losses to offset some of those capital gains in the year of the sale. That can be really attractive if you have a upfront sale or if you have installment sales as well. So it's not necessarily right for everybody. So the really big key takeaway here is sit down with us. We want to go through, does it make sense if you're near liquidation or upon a liquidation event to get some of your equity exposure through a direct index and a long short strategy? The second would be focused on more of the real estate investment world, and this is focused on qualified opportunity zones. This is something that Congress is looking at. Right now, the tax liability is deferred until December of 2026. Think of a qualified opportunity zone as an incentive for you to place investments in real estate around the country that they're looking to grow. It's not the right fit for everybody. It's only available to what we call accredited investors. We can define more of that later, but there, I think there are some opportunities there for those that are looking to get some real estate exposure through qualified opportunity zones. And last but not least is charitably giving. So if you are charitably inclined, a donor advised fund is often a way in which we can gift assets and get a charitable deduction in the year of the gift. That's really important. It happens in the year of the gift. So if we can time that with the year in which you sell your business, we can often get a much greater deduction. The type of gifts you can give can be cash. They can be appreciated securities. So if you bought Facebook back in 2000 and you've been sitting on it all this time, you could gift some of that stock. The other is privately owned business equity rights. So there are some more limitations to the privately owned business equity rights, but you do have the ability to potentially gift some of your business into donor advised fund and get a deduction on the front end. So lots of different ways that you can mitigate and minimize tax in the year of the sale. We want to sit down with you and go through upon even prior to exit. Let's put together a plan in place to minimize your tax. So now we're going to take you to the very end, which is we gave you 5 questions. Bjorn, do you want to finish this up here?
You got it. So let's add up your score. So take the responses from those 5 questions and talk a little bit about what that score might mean. So if you scored between 20 to 25 points, you're probably pretty well prepared right now and just need to start working with professionals to make sure your ducks are in a row to move forward or for the eventual exit from your business. If you scored 10 to 20 points, then there are definitely some areas that will need to be addressed. Planning is going to depend on which of those areas need the most insight, but there's definitely work that can be done immediately right now. And then if you scored less than 10 points, you're not alone. And quite frankly, you may have answered these questions more honestly than other people on the webinar today. So, but as we discussed at the beginning, only 2% of business owners know the value of their business. And that's why we're here to help and why we're doing this, right? We often say that exit planning is simply just good business strategy. You should not be waiting until, the year in which you've decided that, okay, 2025, I think I'm going to sell my business by the end of the year. The best time to start looking at this is, 3 to 5 years out at least to get yourself ready for that eventual exit. Let's move on to the next slide here. And this is a little bit about how we can help. So we know you're working hard as a business owner and we know your time is valuable. So we always use the analogy, partnering with us is like using one of those walkways at the airport. We just help you move forward faster with ease. So we're going to help you understand the value of your business and how to increase that value while you still own it. Build a retirement model and a withdrawal strategy. Discuss and implement tax reduction investment strategies, and then manage wealth for your life, but also for the potential inheritance that you think you might be creating, as an estate for your beneficiaries. Jack, why don't you finish it up for us?
Yeah, thanks, Bjorn. So we covered a lot today, hopefully good, and hopefully you've identified maybe some areas of planning there that you can start taking action on. We mentioned a gift. We mentioned there'd be a gift at the end of the webinar, so we're about that time. So if you want to go a step further and apply kind of the items that we just discussed to your own personal situation, we have spots available over the next 2 weeks for a complimentary all wealth business valuation meeting. So we want to sit down with you. By the end of this meeting, we'll have outlined really key observations and opportunities across 3 major areas of planning. So consistent with our message here today. The first is going to be the business valuation insights, and this is going to be your business valuation report. That's going to help you better understand your company's current worth and the factors that can help increase its value. So Bjorn laid out what are the 4 different types of valuation. We're going to produce where are you today and what are the 4 different types of valuation. Proactive tax strategies is number 2. So how do we help you keep more of what you earn? Nobody wants to pay a single dollar more to Uncle Sam than they have to. So what tax strategies can we look to implement today and into the future to help keep more in your pocket? We as advisors care a lot about the net number. And the third is the retirement readiness. And this one really focuses on a review of your current saving and investment approach to help ensure it supports a secure and lasting retirement. So we illustrated just how important a withdrawal strategy is with that Mike and Ann example. Don't leave your long-term objectives and success up to luck. Sit down and build a proactive tax and withdrawal strategy to make sure you accomplish what you want to do. So if this sounds like something you'd find valuable, simply scan the QR code on the screen to book your session. As we mentioned, we'll have some limited spots available. So over the next 2 weeks, go ahead and please sign up for that complimentary consultation. So please do not wait. Thank you so much for joining us today. We wish you all the best in your journey toward a confident and fulfilling retirement. Be well, and thanks for joining us. Thanks, Bjorn. Thanks, Sydney.